could you explain to our audience what it means when, for example, just this week, the Treasury bought back $6 billion of its own debt? What does that mean?
Well, the maturity, and this started under Robert Rubin, where they started to shorten the average maturity of the national debt because doing that lowered the interest rate expense because people are willing to loan the government money at a lower rate if they get paid back sooner because there's less risk of inflation and less interest rate risk. But it's a negative for the U.S. in the long run because it leaves us exposed. In the short run, it does reduce our costs. So it's the same thing as a homeowner. You can opt for a variable mortgage or you can take a fixed rate mortgage. If you take a variable rate mortgage, it's generally cheaper the first year or the second year because, of the low rate, but you leave yourself vulnerable to rising rates. Whereas the prudent thing to do is to lock in a fixed rate that you can afford, and you don't have to worry about what happens to interest rates. Well, the U.S. government went for the variable rate because they only gave a shit about the short run. They didn't care about future administrations getting stuck with a big bill when interest rates rose. So we this is a ticking time bomb, and the debt keeps maturing, and we have to roll it over at higher and higher rates of interest. And so the whole thing is spiraling. I think by next year, we'll be spending $2 trillion a year in interest on the national debt.